in this lecture example, we are going to be looking at paragraph 26 and paragraph 27. Now, just as a word of caution here, the big point behind what we're trying to do here is we are trying to look at assets that were acquired before 1 October 2001, and you need to remember that their base cost is calculated as follows. You need to know this all by heart. Valuation, date, value, plus other costs after 1 October 01. Alright, now our big question is how to calculate that. Now I'm just warning you guys again. What we are going to be doing here, first up, this is for assets before the 1st of October 2001. Now if you look at what the current year is, this is very long ago. So this is not as common as it used to be. I don't want you to memorize paragraph 26 and 27. You'll see I'm going to show you, I'm going to talk about paragraph 26 and 27. I don't want you to memorize it. I tell you here how to do it. Right, what to do. But I'm not going to go through it right now. I'm going to do it actually by showing you in the act how to read it. And that's what I want you to do. If you can't come right, guys, then I want you to take this valuation date value and in an exam just write that it is the greater of market value, time apportionment base cost, or the 20% rule, right? You choose whichever one is the biggest, you use that amount, and you carry on. Very often you'll be correct, and in my opinion, guys, this is a quick way of doing it. It won't necessarily be correct. It will be correct if it's paragraph 26, but if it's paragraph 27, you won't necessarily be correct. But it all depends on how well you can understand this section. If you can understand this section very well, as I'm showing you how to read it, awesome, go for it. If you don't, then say it's the greater of these three and move on. It is not something that will make you fail if they do ask it. It shouldn't. Right, so here we go. So what I'm going to do, guys, you'll see, I'm going to give you these two paragraphs, paragraph 26 and paragraph 27. I've given you guys two illustrative approaches for paragraph 26, one, and then one for paragraph 27. And this should be able to answer you all of the questions. Then you will see that there's an example. I'm not going to do it with you guys. But with this example, this will give you extra opportunity to test yourself whether or not you know it. So this is a very detailed example. If you can do this, then you can definitely calculate all base costs ever. Alright, so guys, you've got these steps and things here. I'm going to follow the same steps because I want you to see what it is. And at the same time, I'm going to be referencing it to the act. Okay, so this is our first example. So I'm just going to, let's read it first. So it says, A Limited is a registered VAT vendor with a 31 December year end. A Limited purchased a factory at a cost of 2 million rands on the 1st of May 2001. So there you can see this is before 1 October 01 and brought into use on that date. On the 1st of August, A Limited disposed of this for 4.5 million. A Limited had to pay the agent's commission equal to 10% of the selling price. Other advertising costs of 20,000 were incurred. Market value on 1 October 2001 was 2.3 and the time apportionment base cost was 2.1. They give it to you. Okay, now what I want you to understand, what you need to see is that there are two paragraphs, paragraph 26 and paragraph 27, that tells you how to do it. Now you need to be able to decide which one is which. Now I'm going to show you what that asks. So the first one is paragraph 26 and I'm going to show you what it says. It says, look at the heading. The valuation date value where proceeds exceed expenditure. Right, so where proceeds is greater than expenditure, and that expenditure is the cost of the asset. So where the proceeds from the disposal of a pre-valuation date asset, so that's an asset before 1 October 2001, exceed the expenditure incurred before, on, and after the valuation date, the person who disposed of the asset must, subject to paragraph 3, adopt any of the following as the valuation date value of that asset. Okay, so now I'm going to show you what is meant by that. So the first thing is, I want you to understand that to decide if we want to use paragraph 26, we need the following information. We need the proceeds amount, and we need the total cost. And this is before, on, and after. So before and after 1 October 01. Okay, so how do we do that? We do it by using the following format. costs before 1 October 01, costs on or after 1 October 01, and a total column. Okay, now all that we do now, guys, is we split it. So what I want you to see, what we're first going to do is we're always going to say cost less allowances. Because, remember, any capital allowances that were claimed against this must be taken into account, will reduce that base cost. So we must say cost less allowances, because if you've claimed an allowance for it, it's no longer cost. Cost less allowances gives us what is called the tax value. Right, and then to that we say plus other costs incurred. Right, so now what I want you to see what happens is the following. This asset was purchased for 2 million in 2001. Now that determines where you put it. So the cost in this case will be 2 million rands in the costs incurred before 1 October 2001. Now the allowances, guys, and at this point in time, it's more for information for you. You get a 5% section 13 allowance on buildings, on factory buildings, and we used it for 14 years, 2001 to 2014. All right. Again, I just want you to more pay attention to the treatment. Now what I want you to see is, can you guys see? We put everything, the allowances goes where the cost goes. You don't say that for year 1, 100,000 was in this column and 1.3 million was in that column. Right, doesn't work like that. You're saying, of this cost, how much have I written off? Okay. So no other costs were incurred. And this is just the cost of the asset that you claim allowances on. Right, so 600,000 rands. Nothing, 600,000 rands. Now we have other costs in here. There's agent's commission of 10% of the selling price, so 4.5 million. Right, so agent, 4.5 million times 10%. Now we sold this property in 2014, so it's a cost after 1 October. So it goes into the cost after 1 October. Right? Then other advertising costs of 20,000 rands were incurred. All right. So that gives us our total cost, 600,000. Okay, now what I want you to see is I call this A, B, and C, just for reference purposes. What they're asking for is, they told us we need to have the total cost before and after 1 October 2001. Now, this total cost after 1 October 2001 is this 1,070,000. Alright, that's step 1. So I just want you to see here, guys. Step number 1. You'll see I've even labeled it there. Same thing for you guys. Step number 2 now is where we need to calculate our recoupment. Okay. Why are we calculating the recoupment? Because proceeds is calculated as the selling price less the recoupment. So we need to know what the recoupment is in order to calculate proceeds. Right, so now the recoupment, I'm going to do this pretty quickly, guys. This is a whole study section on its own that you will do in future if you have not yet done it. Right, so recoupment works as follows. You take the tax value of the asset, which is what we've calculated. So cost less allowances. And you take the total one, 600,000 rands. And you use the selling price. But when you do the selling price, you always say limited to original cost. Now, the selling price in this situation was 4.5 million, but the original cost was 2 million. Now I just want you to see why we do this thing. And again, guys, if you don't get recoupments right now, the calculation, it's not the end of the world. You will do it in more detail. Right. The selling price, what I want you to understand is that the recoupment can never be more than this past allowances of yours. Now, if you use the actual selling price, 4.5 million rands, so you say 4.5 million minus 600,000, that is 3.9 million rands. That is more than our allowances. So how these rules work when you calculate the recoupment is you say limited to original cost. So you can't use more than the original cost. So now we say 2 million minus 600,000 is 1.4 million rands, and that is our recoupment. Right. Again, for your purposes at this point in time, I want you to just understand that you have to calculate the recoupment. Now we can calculate proceeds. Proceeds, so that is the next step. Right, the next part. Proceeds is our selling price, 4.5 million, minus the recoupment. Okay, so 3.1 million. Now I want you guys to see. Now you can decide if you use paragraph 26 or paragraph 27. Now we haven't looked at paragraph 27 yet, but what paragraph 27 says is basically where proceeds is less than the total cost. That's basically what it tells us. Now, in this case, for paragraph 26 is where proceeds exceed the total cost. Now, proceeds is now 3.1 million rands, and total cost, which is part C in my solution, is 1,070,000. So can you see? Proceeds exceed total cost. Then they tell you, okay, if you have that, then the valuation date value is any of the following. The market value of the asset, 20% of the proceeds from the disposal of the asset, after deducting from those proceeds, costs which are allowable in terms of paragraph 20 on or after the valuation date. So costs after 1 October 2001, or the time apportionment based cost. Right, so guys, how are we going to do it? So now I want you to see. We will now say, okay, we're now ready to calculate the valuation date value. So we will say proceeds, and I'm going to put down the amount, 3.1 million rand, exceeds total cost, which is C for you, of 1,070,000. So if total proceeds exceed total costs, we use paragraph 26. This paragraph says you may use any of the following: market value, 20% rule, or time apportionment based costs. So thus we use, and I know it says here, this is now important, you may use any of the following. And guys, for an exam, you must always use the higher of. You must always say higher of, market value, time apportionment based cost, or the 20% rule. Now the 20% rule is 20% times the proceeds. The proceeds amount is 3.1 million. Minus the cost incurred after 1 October 2001. I want you to see, guys, it is part B there. So minus 470,000. Okay, so that gives us 526. Our market value that they give us in the question, the market value is 2.3, time apportionment base cost 2.1. So market value 2.3, time apportionment base cost 2.1. So which one is the greater? Market value. So it does use market value. Now guys, what if we calculated up to this point? I want you to remember the base cost is calculated as valuation date value plus other costs. All that we've calculated up to this point is this valuation date value. We have not yet calculated the full base cost. And can you see, I said to you the valuation date value is the greater of market value time portion base cost of the 20% rule. And that is exactly what you are seeing here. That is why this one works out very often. Now we need to calculate our base cost. So how do we calculate the base cost in this case? So now you just put down this formula that you know. It is the valuation date value, which we just chose to be 2.3 million rands, plus other costs after 1 October 01. And that is column B again. That's 470,000. Right, so 2770. So our capital gain is proceeds, which we know is 3.1, less the base cost, which we just calculated as 2770, gives us our capital gain. So guys, as you can see, this is a lot of work, and this is my reason why I do not believe that it will necessarily really be asked as much as it used to be asked, because how long it's passed. And this is a lot of marks for a concept. So, right. I will now also continue by just showing you how paragraph 27 works.